How to calculate a cap rate in real estate. What's the secret formula investors use to determine the value of real estate? In this video, we're going to talk about cap rate and how to calculate it. The cap rate can make or break a real estate investment. How do you calculate one? Let's break it down. Do you want to quickly compare real estate deals? Well, cap rate can be your best friend. This is the step-by-step of how you calculate it. By the end of this video, you're going to understand what a cap rate is, what it tells you about a property, and then how to use it to make smart investment decisions. First off, what is a cap rate? Well, it's a ratio, it's a formula. And how do you calculate that formula? It's the net operating income divided by the cost to purchase the real estate. What does that mean? Net operating income is the gross revenue minus the expenses, gives you the net operating income, and that's the profit that you generate per a property. Divide that by the total cost of buying a property, meaning the cost that you've spent or the price, plus any closing costs, plus any improvements that you make to the property, and then you divide it by that net operating income. That's going to give you a ratio. So that essentially would be the return on the investment for a property you purchase if you were to buy it all cash. It's important to understand this is what investors use to evaluate what is the return that I'd be getting if I were to buy this property. So a higher cap rate means that you're paying a lower price and getting a higher return on your investment. A lower cap rate means you're paying more for the property because you're getting less of a return on your asset. Why are certain properties valued at low cap rates versus high cap rates? Well, it all depends on the quality of the revenue that comes in. If you have a triple net property, meaning that it's a McDonald's. The McDonald's pays all the taxes, insurance, the maintenance, everything that has to do with operating that property, and they just pay you for the building, for the right to be on that land in that building. That is a high quality tenant, and as long as people keep eating hamburgers, and I think they will, the tenant will pay the rent. So the landlord or the investor knows this is a very secure stream of income, and investors are willing to pay a high price or a low return in order to have that stability of income, especially if they're on a 20-year lease. That would be a low cap rate property versus an older mobile home park in a rural area of America that has suboptimal tenants. An investor is gonna want a high cap rate for dealing with all of those issues or risks involved with owning that type of asset. They may want a 9 or 10% cap rate for dealing with all the headaches of a mobile home park. This is the difference between the quality of property and how it equates or correlates to a cap rate. So now you're evaluating properties. You want to know, is it a low cap rate or a high cap rate? Well, the first thing you would do is look for listings for sale, and when you look at those listings for commercial property investments, you're going to get the offering memorandum by the broker. This is the real estate broker who's marketing and selling the property. When you get that offering memorandum, brokers many times can manipulate the cap rate by not stating some of the expenses. This doesn't only go for brokers, it goes for sellers that are selling directly as well. They forget to add in some key expenses like property management, long-term maintenance. These things cost money and you need to hire staff, and they don't factor them into the overall operating expenses of the facility or the property. That's a problem because it shows that you're making more profit than the property actually generates, and it makes it look like you're getting a higher cap rate than you actually are. If you're an investor, you hire maintenance staff, there are repairs that need to be done, and there's going to be a cost to having a management company on the site or managing and collecting the rents. This is important because this is going to increase your expenses, and you are not going to want to do this job yourself. So it's going to factor into your overall cap rate. The second thing brokers or owners do to make the property look like it has a better cap rate than it really does is they'll put on there the pro forma rents. What does that mean? It just means the projected rents in the future, not the current actual rents today. So they're going to share what the possible cap rate could be down the road, but the property actually isn't achieving that now. So if you see a 7 or 8% cap rate on pro forma, that means you have to go in and fix the property, you have to raise the rents, you might have to lower the expenses, and then you'll hit that cap rate. So don't be deceived by a pro forma cap rate versus the actual cap rate based on the property's performance in the past. Now, to validate that offering memorandum, you're going to want to look at some key documents. Number one, you're going to want to look at the trailing 12 profit and loss. That means the trailing 12 months, the past 12 months of the operations of the property, how much revenue really came in, how many expenses did they really pay, and then what's the net operating income based on that performance. Second thing you want to look at is the rent roll. how many tenants are actually paying, and then how many tenants aren't paying and have delinquent rent. If the money's not actually hitting the bank, then you can't count for that revenue. And many times brokers or sellers are going to want to account that rent, yet it's not really hitting the bank and they're not showing the true occupancy on the property. The third thing to check when you really dig into the deal is tax returns. It's nice that they show on their profit and loss that the money is hitting the bank, but you want to check the tax return because most people are pretty honest when they're stating or filing their taxes for their revenue, and that'll validate that the revenue is really there when you're evaluating the property to support the cap rate that they're sharing. Now remember, when calculating cap rate, this doesn't always equate to return on investment because there's no debt involved in this calculation. This is a mistake a lot of beginners in real estate make. It has nothing to do with the type of loan you get on a property. But you do want to factor in, if you do get a loan and you know what interest rate you're going to be borrowing at, then you can measure that against the cap rate to see if you are going to get a return on investment as long as you're getting debt. So if you have an 8% cap rate when you're buying a property and you're borrowing at 7%, then the property's generating enough revenue to cover the debt, and then there's still a spread left over for profits. So to be clear, the cap rate is different than ROI. ROI is the return on investment, and in the next video, I'm going to get into what is ROI, and we'll break down that calculation. So do you always need to buy a property at a high cap rate? Not exactly. So at my firm, Patriot Holdings, we don't look at just the current cap rate, we look at the stabilized cap rate. And sometimes that's called stabilized yield to cost. That's what the fancy Wall Street guys use as terminology. What that means is after 2 years of owning the property, that's the stabilized period where you're able to raise the rents, make the improvements, and then you'll figure out what the net operating income is at that time after you've improved the profitability of the property. And then you can calculate what the stabilized cap rate is based on your cost, the price plus the improvements you made, and then divided by the net operating income. So even if you're buying at a 4% cap rate, but you know there's a lot of potential where you can raise the rents and you can make improvements and you can lower the expenses, you can get that cap rate to an 8, 9, or 10% cap rate and create a lot of value. So the stabilized cap rate in our eyes is more important than the current cap rate as long as you know what you're doing and know how to add value to that property to raise up that cap rate. But you need to let your lender know that this is the plan, because if you're buying at a 4% cap rate but you're borrowing at 7%, the property's going to lose money. So the lender needs to know the story, and you need to be able to execute in order to generate profits, because when you buy the property, it's going to be negative cash flowing. So now that you know how to calculate a cap rate on real estate, go to patriotcalc.com, put your project in the calculator, and then you'll know what the cap rate is on that potential investment you're thinking of buying.